Avon Resources Limited is a gold exploration company with significant projects in British Columbia, Saskatchewan, and the Yukon. Trading on the TSX Venture Exchange, symbol ABN, and the pink symbol ABN-AF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Drew Zimmerman, Derivatives Portfolio Manager at PI Financial in Vancouver. His website's pifinancial.com and polarfuturesgroup.com. Welcome back to the show, Drew.
Thanks for having me on, Jim.
Drew, is it pretty interesting right now? It seems to be a real structure to the stock markets now. 2 days down, 1 day up. We've seen this bounce now for a month or two. Do you expect this to continue?
Yeah, and I think that's a symptom of just an overall change in sentiment that we've seen. For years. We've gone on 10 years of a bull market now, and when everybody is trained to buy the dip, is the popular saying, or there is no alternative, the TINA expression. Everybody was trained to, if we did have a down day or a few down days, you just come in and buy the market, and it'll rally back over the coming weeks, and you're better off. So the last month and a half is more of a prolonged session of a change in sentiment. Investors are questioning whether, should I come in and buy? And if they have, they've been, knocked out of their position or, are holding on to losses. So that's the first time that we've seen some real, continual downward pressure on stock markets for the last little while, even when we had the bout of volatility and the VIX sort of driven stuff at the beginning of February of this year. That was very sharp and very sudden. But again, it wasn't as long lasting as the drawdown or the change in sentiment that we've seen this time. And again, we're seeing it now more in the momentum names that had been the leader on the way up. So during the last couple of weeks, we've seen the Nasdaq be the weaker market in the U.S. compared to the S&P or the Dow that are a little broader. And again, the Nasdaq being the momentum names, the FAANG stocks that had been the leader on the way up. So we're really looking to those markets to see where they're going to lead us on the way down. And again, that they took out October's lows isn't a good sign, having a little bounce back here today. But again, holiday light sort of trading volumes out there today as we go into the U.S. Thanksgiving tomorrow. So that change in sentiment, I think, is here to stay for a little while. We had gotten so frothy, the valuation's so high. We had Apple and Amazon both become trillion-dollar companies for a short period of time. And now you've got more worry rather than a fear of, missing out of being part of that next trade over the next 2 weeks or the next month. So I think this sentiment could stay around for a little while yet. I'm not saying that we need to see, another 20% drop in some of these stocks. We've seen some pretty big drops in some of the momentum names. But again, I think it's just going to be a little bit more caution than we've had over the last couple of years in the market, with people willing to step in and buy. They're going to be a little bit more tentative.
Apple addicts, and we know they are because they'll line up around a store in the rain and snow for almost a day to buy the latest product. Apple announcing that it's cutting back the manufacturing of its latest iPhone models. Plus, they will no longer disclose their sales figures for that phone. Is that a sign that they might be in trouble or they're consolidating?
Yeah, they've had a few announcements that are, to quote different market analysts, troublesome. And we've seen that get reflected in the stock price. As I said, when they were up at $1 trillion valuation, they were trading at a high over $230. We're under $180 now on the stock. So, that has been priced in. There's, worries that, even though they're not going to disclose the iPhone sales now, that's because maybe that side of their business is starting to slow down. So they want to try and move the emphasis, as magicians do. They do the trick in their left hand while they're waving their right hand at you. So if Apple's trying to sort of get your attention with the other part of their business, by stopping the disclosure of number of units sold on their iPhone side, which has been, the big bread and butter of their business, maybe that does show you a shift, and I think that shift is getting priced into the market more and more. And then again, just with the overall market rolling over as well, that general sentiment is going to come and hit that stock maybe a little bit more than it had. I mean, Apple had been one of the few or the last remaining tech stocks to really hang on to its lofty valuations. It's the longest as we've gone into this sort of sell-off period. So it is also the big leader in the stock market, just market cap size, that sort of thing. So it will get a lot of attention, and it's also in the Dow, which you don't see a lot of the momentum stocks on the Nasdaq side be in the Dow as well. So there's definitely a lot of importance being placed on Apple. And now that it's started to break down, it's definitely got people's attention.
Amazon, are they expected to keep their value because they get busier around Christmas time?
Well, that was part of their sell-off earlier in the last few weeks, was when they reported earnings. It was about giving softer forward guidance. So if they're putting a low bar out there for the holiday season, maybe they have the opportunity to beat that and then perform a lot better on the share price once they've done so. They definitely did, and I mean, by putting a weaker forward guidance out there, you do have the reaction that we've seen. And again, maybe the Amazon stock wouldn't be down as much as it is if the general market wasn't rolling over and sentiment wasn't as poor as it is. But again, by putting that out there, they have rolled over. Do they have the ability to beat? Absolutely. I mean, more and more people that I know, myself included, are using Amazon Prime for your own gifts, your own needs around the holidays, that sort of thing. So I think it's definitely possible they could continue to do better. But again, we'll have to wait and see what those numbers are, and just the retail consumer in general. Do we, as consumers, have the capacity to go out and consume more this holiday season than we have in the past?
Well, the latest survey says Canadians plan to spend the same this year as they did last year. However, having covered that survey for the last 40 years or so, nobody ever meets that goal. They always spend more than they plan. And plus, we have Ottawa saying they're likely going to legislate the postal workers back to work full time. They've been holding rotating strikes in Canada. Is that really good news for the online business, which of course every year grows by leaps and bounds?
I mean, getting the postal workers back to work would be great news. You have to deliver those online products somehow, and Canada Post is the way that gets done by and large in Canada. So that is a critical component of the online shopping process, which would help them. And yeah, as you say, I mean, every year we say, well, maybe we'll spend the same, and then whether that's online, finding more sales, or being in a mall or a store and seeing sales, the tendency is always to spend a little bit more. That's what our sort of consumption culture is built on. So, it shouldn't be a surprise that they sort of undercut that going in. But again, as you say, that's been going on for 40 years, so there really shouldn't be a lot of surprises on that front as we go into this holiday season.
We'll have more with Drew Zimmerman right after the break.
I'm Douglas Mason, CEO of Naturally Splendid, symbol NSP on the TSX Venture Exchange. Naturally Splendid is a biotechnology and consumer products company focused on the global cannabis and health markets. Naturally Splendid is expanding distribution in this rapidly growing market with products currently in Canada, the USA, South Korea, Germany, and Australia. To view our comprehensive company presentation and for more information, please visit our website at naturallysplendid.com.
MGX Minerals is revolutionizing the new energy economy with patented lithium extraction technology, replacing traditional solar evaporation using low-cost, low-energy nanofiltration. The first system of this paradigm shift technology is currently being commissioned. MGX Minerals trades on the CSE, symbol XMG, the OTCQB, symbol MGXMF, and Frankfurt, symbol 1MG. For more information, visit our website, mgxminerals.com.
Welcome back. We're speaking with Drew Zimmerman. Drew, with the markets in a very bumpy phase, have they lost the value that they have gained since January and then back to now?
On a year-to-date basis, yes, the Nasdaq is actually still green. The Dow and the S&P are flat to negative, depending on where you market here in the last day or two. So yeah, there's been a tremendous give back of wealth, of market cap in these shares. But at the same time, my perspective on it is, if you look back and you ask somebody, what was the sell-off in 2008? Are they telling you from, the recent high, the 52-week high, to the low? No, we always hear it as, stocks were down X in this year. So if somebody was to look back from, 2019 or 2020 and say, in 2018, stocks were just flat, does that sound that bad? I mean, it sounds bad if, certain stocks are off more than 20% from the recent highs. But when you look back and give it some of that perspective and you say, if we're looking back at 2018 right now, stocks were flat on the year, people would kind of shrug and say, well, that wasn't great, but not so bad. How did 2019 do? That sort of thing. So I think we do have to be careful that, it's very easy to look back and say, okay, stocks were off 5% or 10%, and, well, that is considered, a correction, although a correction is always usually measured from the highs. Giving it a little bit more perspective to say, we haven't had a down year in stocks in 10 years, maybe we should expect something like that. So everybody wants to believe that we can have a Santa Claus rally, that does tend to happen seasonally. But I think we need to be a little aware that, even having a 5 or 10% down year overall isn't that big a deal given, what we've seen in the stock market over the last 10 years. But, that does mean starting from about the level we're at now as zero. So there could definitely be some more downside without having to really, lose it on a year-over-year basis.
Is this the time for positioning, start diversifying into other products so that if the stock market does decide to do a January nosedive like it did last year, or the start of this year, I should say, you're protected?
Yeah, I think there's definitely a lot to look at through the markets. I mean, as I was saying, with the Nasdaq still being up this year, they've had the momentum names that have really outperformed all other parts of the market. And then there's definitely other areas of the market, whether that's been, commodity stocks or commodity companies, in the grain space, in the metals and mining space. They've underperformed a lot of those names. And then especially, near and dear to our hearts in Canada is a lot of the energy names, and especially the more oil-specific energy names. I mean, oil overall has had a terrible couple of months since the beginning of October. I mean, we're trading back down at, just under $55 a barrel after being over $75 a barrel, even less than that in Canada or Western Canada Select, trading as low as $13.50 a barrel recently. So you're seeing, maybe some opportunities where, those stocks are, had been out of sync with the rally on the way up, but now, maybe are at such depressed levels where they're trading at, intrinsic levels, cash levels, whichever ratio you might want to use, specific to that sector, to be, a very good buy. And, therefore, if you're buying at really good prices, inherently you're taking on less risk than if you're buying at something that's, just making new all-time highs and worth $1 trillion overall, as Apple and Amazon were.
Drew, an interview I saw on Bloomberg BNN, Cal Broder, the CEO of a corporation in Calgary, BFH, which has developed a way to turn bitumen back into its original product, which is like a jelly, put it into shipping containers and then move it that way. He says it doesn't pollute, it floats on the water, it's not toxic to fish, and apparently it's much cheaper to put oil in these jelly-like cubes into shipping containers and send them to Asia than it is to put liquid oil in a tanker. Plus, I guess the environmentalists should be happy with something like this, non-toxic oil. Is this perhaps the solution to get low-price Canadian oil into Asia and up the price?
Well, Jim, I'm not familiar with that product specifically, but I would say when you have this sort of circumstance where we are in such a predicament as exporters of our energy products, companies like this will innovate, and that sounds great. I mean, I think that is where great new companies come from, is they see a need in the market, and in this case I would classify it a desperate need, and they've come up with a solution, and a solution that might be better than some of the existing things that we already have, and much more economical, and from the sounds of it, more environmentally friendly as well. So again, I think it's a solution that we need to find or work towards. Obviously, the national government trying to get something done with buying the Trans Mountain pipeline that they're looking to double, but again, some delays there, some delays on another pipeline going south, the Keystone XL. So, it is a situation that needs a solution. So, I mean, my hat's off to these guys if they found an innovative way to do that really makes a lot of sense, and on a business and environmental front, that they should go ahead and do so.
Right, and the railways are trying to ship oil, but they don't have enough tanker cars. This product you can put into regular shipping containers because it's not toxic. They don't have to go through environmental hearings. This perhaps could be the solution. And instead of building that pipeline, maybe they should just build more container cars. Well,
from the sounds of it, yeah, and it's checking a lot of boxes, and I think the best thing, it sounds like, well, not immediate, as in they can't start doing it tomorrow, sounds a lot more immediate than some of the other solutions, whether it's, as you say, building more oil capacity on the rails, or by building pipelines. Those are both longer processes. So if they could start doing this right away, that's better for Alberta, that's better for these oil companies, that's better for Canada in general. So, like I say, it's a solution that we need to find some answers to, and if this sounds like one, all the power to them.
We'll have more with Drew Zimmerman right after this.
Grand Portage Resources recently completed the 2018 drill program on its 100% controlled Herbert Gold Discovery property located in the prolific Juneau Belt in southeast Alaska. Drill results are expected through late 2018. Past drill results included numerous multi-ounce gold assays on multiple veins. Grand Portage trading symbols are GPG on the TSX Venture, GPTRF on the OTCQB, and GPB on Frankfurt. For more information, please visit our website, grandportage.com.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Drew Zimmerman. Drew, is there more interest in gold if the market is going to be this bumpy?
Gold has really caught my eye in the last couple of weeks. I would say over the last few months, I've been watching gold closely. It looks like it wants to go higher. It tried to go higher over the last couple of weeks, then broke back down from being at 1240, 1250 all the way back down to 1200. But now sort of getting some more momentum behind it. We're seeing the open interest. That's the number of people holding gold contracts on the futures exchange. That's the physical gold. Really start to pick up. So that shows me that some of the interest is maybe coming back. That again, the the gold levels are low enough, and there's enough, worry out there in geopolitics and in just general economic situations where people might want to be parking more money in gold. But then the CFTC, which is the futures organization that tracks people that are holding these positions, are still showing that speculators are, on a net basis, largely flat to slightly negative of the precious metals. And normally, speculators over the last several decades have always held a long position. So, while that's not a timing tool, it's only a weekly release, I think you have to look at that and say, if we start to see some interest in the precious metals at these levels, and I think there's some reasons why we should, especially if the Fed is going to have to slow down a little bit in 2019 with their rate hikes like we think they may, then you're seeing, both the real rate story and maybe this worry story start to give gold a little bit of a bid. And with the U.S. dollar index having been, recently back at 16, 18-month highs, has it sort of had its big move already for the year? And if the U.S. dollar even stabilizes or just moves a little higher, that won't be such a headwind for gold like it has in the past couple of months. So I think there's definitely some interest in the gold market going forward. As I said, it's trading a little choppy on the price action. I think you really have to look at it and say if it can break firmly above 1250 in the coming couple of weeks, especially if this equity market volatility was to continue, then that would be a great sign. But we get some weird days like we had yesterday where equities were really selling off. And the sort of safe haven assets like bonds and gold didn't move at all, and gold was actually down on the day yesterday. So there's not always a straight relationship in the market, and a lot of the time once you figure it out, it seems to go away. But again, I think if you're just looking at the gold chart on itself, not in relation to the equity markets or the bond markets, a technical breakout above 1250 could give us a good run to the upside. And again, the fact that so many investors are out of the gold market or even positioned against the gold market, if we started to see a broad rally in gold, then that sort of mass of people has to come back into the market. That could be a pretty good wave of buying that could carry the gold prices much higher.
Is there still a general attitude out there that gold is just a bunch of shiny rocks and you should be looking at other stuff?
Yeah, I mean, there's always going to be people that don't believe in gold as a store of value, but I mean, you can argue it's been around a lot longer than people have even been writing about it. So it's definitely got a long history, and I mean the flip side to that is the newest, latest, greatest Bitcoin, the other answer to something that's non-government, non-fiat currency. And with this week, Bitcoin breaking under $5,000. So, Bitcoin just continues to struggle, doesn't seem to have that bid come back into it that people thought it might or thought it should if we saw some more volatility in the equity markets or just general geopolitical volatility. So, the younger generation had kind of moved towards Bitcoin and thought maybe that would be a store of value, but definitely as equities have, gotten a little bumpy in the last month and a half, I would have much rather been in the gold market than the Bitcoin market, that's for sure.
Drew, thank you so much for chatting with us.
Thanks for having me on, Jim.
My guest has been Drew Zimmerman, Derivatives Portfolio Manager at PI Financial in Vancouver. His websites pifinancial.com and polarfuturesgroup.com. You're listening to HowStreet.com radio. Find us on Twitter at HowStreet. Questions can be emailed to info@HowStreet.com, our YouTube channel, Talk Digital Network. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.